Hello, I'm Stephen Hunt, and welcome to Dodging Bullets, the Insolvency Practitioner's Guide to Surviving the Week. In this episode, we're going to cover the top 10 musicals based on insolvency and attempt to sing some of the songs from them. Oh no, that's another episode. In fact, we've got boring old Charles Jeffrey talking about litigation funding. How are you, Charles?
I'm very well. I'll just throw my musical notes away. So I thought that was for today's episode. So I'll
We,
save those for next time.
we both got it wrong, but it's a good idea for an episode. We did do one that was talking about, based on Oliver, I think. Fees, Glorious Fees was going to be the opening, and then it all went downhill from there. Once someone asked me for a topic. I was doing a talk once, and they asked me for a title, and I said flippantly, Bankruptcy the Musical. And lo and behold, all the flyers went out with Steve Hunt speaking Bankruptcy the Musical, which was, I shouldn't be so flippant.
I don't know. I feel like Les Miserables is probably pretty close for funding certain insolvency claims or dealing with certain insolvency matters, but it's close enough.
This podcast is sort of based on what happens in a bar after a seminar and things like that. So maybe 3-4 in the morning, Bankruptcy the Musical could become live spontaneously. Anyway, let's talk about litigation funding. Do you want to introduce yourself for people who don't know you?
Yeah, absolutely. Charles Jeffrey. I'm the managing partner of Jeffrey Capital. We're a fund and asset management business based in London. Focus predominantly on UK and offshore investments with a keen eye for insolvency, but as well as other, case areas, securities, competition, debt recovery, etc. Real appetite for me is insolvency. I've been funding insolvency claims for nearly a decade. So despite my youthful, wonderful looks, I've kind of been a bit of a veteran actually of funding in London. So it's a real mixed bag, and the market's at a really interesting point now in general. Times are changing quite rapidly from what they used to be. So it's quite a permanent time to have this conversation.
Well, I'm going to come at this from the point of view of an insolvency practitioner customer. So obviously looking from the outside, we're seeing share prices drop on some litigation funders, some leaving the market. There's, I think, legislation in California and other places which are sort of restricting litigation funders. What's going on? You said the market's changing. Is it under attack?
I wouldn't necessarily say it's under attack. I think a lot of people are realizing that actually this is a very hard game to play. Rewind 5, 10 years ago, a lot of funders that were forming or had been newly formed were working with investors, and it's a 4-year investment, and it's a 10 million budget, and we're going to make 3 times return, and that just doesn't happen. Its duration runs long, budgets go over, and quantum comes down, and you have to really understand that yes, this is litigation, these are claims, but to a litigation funder these are assets. They have to be treated as assets, and assets go up, assets go down. And I think some funders, with their investors, maybe got slightly caught out, or struggling to refundraise, or ultimately back the wrong horse in the race. And track record is important. And ultimately, some are fading away, some are going into runoff, some, publicly have had the share prices go down quite substantially. It's very difficult. It's very, very difficult. And I think a lot of people now are realizing just how tricky these assets are to manage.
Yeah, I mean, it's been interesting to watch from the insolvency practitioner point of view the emergence of litigation funding as an option. I think 10, 15 years ago, I recall Harbour being the litigation funder. There may have been others. And Manolete coming into the market with a story about Hastings Pier that was repeated for quite some time, as we're sort of emerging the whole concept of how litigation funding would work in insolvency. Is that your recollection? I mean, it's
Yeah, it is.
for your time, but
It is. And I think what's happened, particularly in the insolvency space, is funders have kind of been identified as to what they're good at and where they specialize. So you take, the likes of Manolete and Henderson and Jones, who are very, very good at what they do, which is, smaller claims for IPs in London and in the regions, and that could be taking assignment, or just having the economics and the structures in place to run smaller claims. We, as a firm, could never get involved in those sort of claims. The volume is far too high, and the quantum isn't enough, and the investment amount isn't enough. We have a minimum investment that's quite high, which is larger than the claim size that these firms are dealing with. So They have their space in the market and they're very, very good at it. And then you have the other funders in town that do insolvency, but will typically do high value claims. Actually, I think the gap in insolvency is the claims where the budget is 3 to 5, 6 million, because the economics on cases like that are quite tight. It's not like it's a 500 million pound claim with a 20 million budget. You've got a number of funders that can get involved in that space. But in that middle bracket, 50, 60 million pound claims, 3 to 5 million budgets, they're quite tricky and they're quite hard to get funded. So the lower end of the market is covered, the upper end of the market is covered, but that middle gap is a tricky space.
I mean, yeah, 3, 4, 5, 6 million will be astonishing to many people, thinking that's sort of the middle ground, and that's bigger than most IPs bring claims at. So most IPs will experience the sort of Manolete end of the market, although Manolete, I'm sure, I don't know what their biggest case is, but they'd certainly look to fund some larger ones. But I agree, you have that distinction in the market. I think there are ones there's one or two which are focused on ones even smaller than Manolete. There were very small bits and pieces, litigation funding firms that I came across, and others I've not really dealt with, so I don't know what their range is, but they're around.
Yeah, I mean, the market's changing in the sense of these cases are just becoming more expensive to bring. And lawyers' rates go up pretty much year on year, whether it's by 5, 10%. And so the budgets of running these claims are getting more expensive. And if you are a funder that can do a lot of the legal work in-house, preparing letters, etc., then your costs of bringing these claims are reduced. But it's getting expensive. And I think for a lot of IPs now, it's understanding, is this case actually worth bringing on an economical basis? Because let's say the claim is 50 million, whatever it may be. If you have got to pay 5 to 7, 8 million just to run it, the funder's going to take their return. And by the time all the fees have been paid, are the creditors receiving a substantial P in the pound? If the answer is no, is that beneficial for everybody? Is it just litigating for fees almost?
Well, I'll come back to the return to creditors. Because that is a point that concerns me. I did some work in 2019 and early 20, just before the lockdown, in looking at pricing. One of the things I was looking at was what's the evidence of pricing by litigation funders, the multiples and the different routes, some of which were affected by the PACCAR case, but also lawyers' appetite to risk. I posed a question saying, if you could get 200 or 300% uplift on your time, would that make you more keen on CFAs? The answer to that question was very clear. No, almost no lawyer would do a CFA for a higher return. Very interesting, because of course, as a profession, they are risk averse. So it was interesting. The pricing, the level of uplift was not a factor in their decision. Litigation funders, however, also didn't seem to be really reducing their price or their multiples. What they were doing was competing by going down market and taking on riskier cases. Probably at the start of the decade, they were looking at very high returns, very safe. Their sales pitch was essentially, we're funding what you would have funded, but we're keeping this off your balance sheet so you can carry on your normal business. And that was adapted into insolvency, where there is no money to fund generally. I couldn't see any change in price either, so I was looking very much as COVID hit as to what did we do as a customer if the price is fixed effectively for litigation funding. No one's really competing on price or multiples, and the lawyers are not really going to fight back by saying, well, actually, we do it on CFA instead if you give us a bigger return, equivalent to the return that was being given to litigation funders. Is that your experience, or would you say that model is wrong as a description of pricing in litigation funding?
I think litigation funding pricing is so varied between funder. I've got friends that work at other funders, and they will every so often, say what their current pricing is, etc. Some will price on commitment, some will price on deployed, some will, go on a tiered multiple, whether it's starting at 1x and it scales up to 4 or 5x. Some say no, we're just doing a completely flat rate. It's so varied, and for the customer, the office holder, trying to distinguish what is the best deal is actually quite hard, because it's not necessarily just about the cost of it. It's understanding who that funder is, what expertise can they bring to the claim, how well do they work with the lawyer, how well can they help manage the claim. So Pricing is obviously, it's important, but it's very, very varied. And it also comes into the same point as you were saying about the lawyers. We typically would prefer the lawyers to take some level of risk, even if it's just a 20-30% discount on their fees, just to help, align risks and incentives. But again, not every funder is on that basis. Some funders want more risk. Some are quite happy to pay the full 100% every month, and it's great. So there's a lot to actually factor in. And as the customer, be it the liquidator, they've got quite a lot of modeling to do to understand actually what is the best deal that they're getting.
I think I might clarify. I think the mechanisms can vary greatly, the multiples and things like that, but the actual price, how much you pay and how much it costs you, don't vary as much as you think. I think they're up here and down there or whatever. It comes back to similar pricing. I haven't seen anyone in the market from the customer end. Maybe that's a failure of their marketing. I would identify as cheaper than somebody else. I wouldn't see in a particular sector. Maybe you see it on your side, but I don't see anyone leaping or anyone conversations between IPs saying, go to that funder, they're cheaper.
I mean, I suppose the only time we see it is when, we'll put a bid in for a case and we'll issue our terms, and the office holder comes back and says, well, such and such funder is cheaper than you. They're lower for whatever reason. And, we'll negotiate for, the right price and the right deals. But sometimes we have had in the past where we've said, we can't do that. And maybe their cost of capital is substantially lower and they can issue cheaper terms. Maybe they see less risk in the case that we do. But one of the biggest factors, and it's something that's really worth touching upon, is, insurance. A lot of funders, will get capital protection insurance on their investments, which is fine. No problem with that whatsoever. And that should, in theory, reduce the pricing because they are now investing at little to no risk. Okay, their insurance premium that they've paid, which whatever percent it may be, but they are in theory investing at zero risk. There's no capital at real stake. So that can be a reason why some funders are issuing cheaper pricing. I don't know if some funders are taking CPI and still charging expensive. I don't know. Great business model if you can get it, but that will have a real factor into why some people are cheaper.
I think that's sort of what I was covering in terms of a law firm has, when it's doing uplift on WIP and things like that, it's really balancing its cost, its wages, its overall bill. The cost of capital in these structures, because of the way they're put together with layers of insurance and other costs and bits and pieces, if they've got similar underlying structures, then their price is always going to be similar. I understand sort of how these are put together, but do you want to expand a little bit more on the role of insurance? Just explain, using, I don't know if you do it in the simplistic model, explain how money from say an offshore investor they want to put into a litigation funder, how would it be insured so the returns are guaranteed? How does that sort of work?
Yeah, so there's different types of insurance. The most one that obviously provides the protection for investors or for the funder is capital protection insurance. It's not something that we have ever taken out. It's something we've inquired on in the past. And what that effectively does is it ring fences the amount of which someone has invested. It is a policy that you take out for X percent premium. So let's say you're insuring £20 million, you might pay, I don't know, a £3-4 million premium. But in the event that what you've invested in, the case, loses, you get your money back. The insurance policy kicks in and it repays all of the capital that you have invested. So you are investing at that point at zero risk, less than the premium that you've paid, and you can even insure that premium amount, so you can even get that back. And so people are taking that out, not just on single case investments, but also on portfolios. They may say, look, we have 5 cases in the cat and we've got very substantial exposure, 100 million of exposure. We would like to insure part or all of that amount of money to provide, so that we can say to our investors, we're not going to lose your money. It's protected, but we've had to buy this premium as a result. And it's a really popular product. It's a really popular product, and I can see why it's so desirable to investors and to funders as a whole.
So as a customer, an end user, I suppose, I'd be saying, well, if you've got 20 million and you get it insured, so let's say 3 million costs off your pot and you've got 17 million left to deploy, why do you need to charge me 3 times 17 million on the return on the funding? Is that what's happening? I mean, there'll be other costs involved, but there'll be commissions and other bits and pieces. But how does that seems overpricing almost?
It's a valid point. As I mentioned earlier, if you are investing at little to no risk, you know, litigation funding is entirely priced on risk. The riskier the case, the more expensive it is, as with any kind of product. So, having not taken it out, I don't know, but do some funders disclose that they've got a policy? I've no idea. I would like to think so, but I really can't be sure. So, in theory, yes, if you are taking out a policy, you should really be able to offer much cheaper pricing because of that much lower amount of risk. And maybe that's why we're not winning some deals and other people are. And maybe that is why they're cheaper. And maybe as an end consumer, you might be very happy that they've taken out the CPI policy because, well, you get cheaper money.
Well, I mean, I've taken out one of these policies myself on my fees, effectively, on a case to try this out. So I understand the sort of model, and I'm interested. Isn't really an answer, but there's a question for me to explore, which is how your attitude to risk or the litigation changes if you aren't having any risk. Obviously, the funder who is fully insured is probably quite relaxed. They want their uplift and a win, but if they lose, it's not a disaster. The lawyer, if they were insuring some of their fees that's on CFA, it would bring down the uplift, or indeed remove the uplift if some of it was paid and the other bit was similarly deferred or insured, and the IP's fees as well. So in terms of my job as an IP, shopping on behalf of my creditors, I suppose, I'm looking for the best deal, be it financial, but also the best way of running the case to a win. My experience, I think, of some litigation funding is, whilst it's sold on the basis of, we've got big pockets and the other side will be dead scared of us, in reality, it's sort of, when's the next mediation? When's the next mediation? When's the next mediation? It's sort of, can we settle? Can we settle? And not all funders, but some have been terrible at that. So making my life simpler, removing the variables, understanding the pricing from a customer point of view, talking to the litigation market through you, I'd be saying, make it easy for me, make it transparent, give me stuff I can understand. That's what I find fascinating about the market. It's providing a service, but I'm not sure the customers understand the value of it particularly, and it's not generally well sold.
Well, it's, insurance has been around for a long time in funding and in litigation in general, your likes of your ATE, etc. And, ATE is the absolute norm. You take it out on every case. Could it be that soon CPI is being taken out on the majority of cases as well? Pricing for CPI is coming down. Certainly, we get phone calls pretty regularly from brokers saying that they can offer policies, and what we're seeing is, as well now, is some cases are being sent to us with CPI already quoted and attached to the case, and effectively it's part of the package. So it's vastly becoming more and more popular. So it will be interesting just to see how many funders really pick up and take off with it. And I think it's far more than I'm giving credit to. I think it is quite popular.
I think that's a good point to move on to, really. How good are lawyers at selling claims to you guys? Do they know what they're doing, or is it very patchy?
Very patchy. It's very, very patchy. But there are some firms who are very, very good at presenting cases. You get a nice summary sheet outlining the key metrics and everything that a funder needs to understand. Recovery, budget, merits, lovely laid out, and then please see Exhibit A, B, C for all the relevant information. That's the dream. You do get some firms that say, "Here's our data room. Please find what you're looking for," and it's impossible. It's very difficult. So the firms that are good at it get funded very quickly. They're normally ones that have been funded quite a lot in the past, but you can normally see quite quickly actually who maybe hasn't had too much funding experience in the past. And for me, it can be a little bit of a red flag if the presentation of the case is very tricky when it comes to actually signing the thing, getting into LFA discussions and negotiations, there's normally a pattern that flows and follows of, it can be quite time consuming. And ultimately that then becomes quite expensive because transactional lawyers, they are not cheap, and it can get quite frustrating. But I think overall, particularly in insolvency, firms are pretty good. Firms are pretty good, but it does vary.
What's the role? I mean, there are funding brokers in the market. Do the brokers assist the lawyers, or are they? What's their role in that? Do they have much impact on that, or should they? I suppose.
Well, I guess it depends on the broker. There are some in particular that are very good and will do the presentation for the lawyer. They've had to go to the law firm and say, "Look, I'll package this up ready." Quite often, it's the brokers that used to be funders. They know what a funder likes, what a funder wants to see. They're very good, rather than a broker that maybe just forwards an email and says, "Here's all this information." So brokers typically are very helpful, and more often than not, might be able to show us a case from someone that we don't have a relationship with, and it's a case that we wouldn't have seen otherwise. But if it's just a case of forwarding an email, or the broker hasn't done almost like a pre-underwrite, uh, they'll just get hounded from every funder saying this, and this is what's wrong with it. Please pass that back to the lawyer. Whereas if the broker is an actual middleman or middlewoman, they can do a much better job.
One of my theories with little evidence, shall we say, is that lawyers who are good at CFA are better at selling cases for litigation. If they're solely reliant on litigation, they're slick at turning it around, but they're not selling the case, as it were. It's to understand the risk where they do some cases on CFA fully, some part funded. It is a lawyer who understands risk much better than someone who simply get case, get it funded, get case, get it funded. Do you agree, disagree with that? Or are you saying there's just specialists out there who are just good at it?
I said a little of both. There are lawyers that are just generally very good at it. But you are right. The lawyers are selling this asset to you. They're trying to convince you to part ways with 5, 10, 20, 30, $40 million to invest in them and their case. So they have to sell it and they have to present it properly. But you are right. Those who have a good appetite for risk are quite often better at selling a case rather than someone saying, "I want 100% of my fees paid every month on the button. Thanks very much." Yeah, we would all love that. Of course we would, but it doesn't work that way.
Going back to, I said I'd come back to this, the interests of creditors. Now, one of the problems an insolvency practitioner has with litigation funding is, I've got my case in, I've got my creditors, they're the ones who agree my fees, they're the ones to whom I've got a duty. And I seem to I'll now be presenting them with two choices. Either I can't get this claim off the Crown, so you get no money, or this claim is so great that litigation funders are all over it, so they're going to take all the profits for it, and you're going to get no money. Those are dangerously slightly extreme cases. The options available for many creditors in many cases. I'm not saying that IPs doing the work on CFA would necessarily change the outcome, because I think some cases where it's not unfundable, CFA is the only thing in town, that's what you're going to get. And on the big cases, it's not possible to fund it for a professional firm to fund it for years without some sort of funder. But I think it seems to me the challenge for IPs is that they watching almost from outside as there's discussions about their case that they've brought to the lawyers, and the lawyers are saying, "Great, we'll go and get that funded." Effectively, the lawyer is saying, "I'll find someone to finance my law firm through this process. Thanks for all the profit fees." And the creditors are sort of now 3 or 4 parties down the waterfall. Almost, they don't really appear on some waterfalls. The bottom line of waterfall says payment to the insolvent state, and we don't think about how the insolvency came about. They wound up the company. They may have taken action. So it's for me, the conversation about the litigation funding engagement loses creditor involvement. I don't know if you agree or disagree, but it seems to be so remote. It's almost, that's the point where the creditors give up in many ways. In my cases, they don't expect a return. They're already unhappy that the insolvency practitioner will charge fees, but everybody else is now jumping in on what sounds like a really good case. Otherwise, they wouldn't be there.
Yeah, we when we're underwriting and when we're modeling these cases, we have a specific, section that glows in our spreadsheet, which is what is going to be the return to creditors. And we will, want to get an understanding of everybody's fees in the case. So, and that includes the office holder, because we want to understand that for us, 50%, 50, should go back to the creditors. That is our preference, and if we're modeling and that box is glowing red, saying it's going to be 10, 15%, we would typically go back and say, look, economically, we cannot make this work. Others may. Others may have different rules, different pricing, different structures, but we personally can't make this work by the time that everyone's taken their fees, everyone's taken their uplifts. It's not going to work for us, so we'll bow out. But it's something we keep heavy on our mind, and it's likewise for creditor approval.
But that's only on a win at court, surely, because obviously settlements could be any number at any stage. So you're saying that if it goes to court and you spend the entire budget and everyone gets paid out, there'll be a 50% return.
Well, we model it at all stages. I mean, we can never, we don't have a crystal ball as to what the settlement's going to be, but we will model for early settlements, medium settlements, late settlements, pre-trial settlements, post-trial settlements, and what we, based on all the data that we have from cases that we've worked on, rough percentages, rough values, and at every stage it will say this is the estimated return to the creditors. So at all stages, we want to make sure that those numbers line up, and we're quite happy to share that with not our model, but the rough numbers to say the reason we can't do this is because on 3 out of those 5 stages, the lion's share is being split between everyone else, and you know it's not the right thing to do effectively.
What stage do you typically get involved with a claim? Is it before the letter of action, or is it before issuing? What sort of?
It varies. I know I keep saying it varies, but what I would tend to say is don't involve us too early, which a lot of funders say the opposite. They think we want to get involved as soon as possible. For me, you wouldn't bring a load of ingredients to a bake sale and say, I'm going to make a pie. Just let me make it first. I said, go make the pie and then bring it to the table. So quite often, a letter of action has normally been sent, and we'd like to see a copy of that. We're very happy to get involved early if there's potential seed funding that needs to be required. That's a slightly different scenario. But someone coming to us saying, "Oh, hey, I've got an idea that I'm thinking about bringing this claim," we would say, have you done the work on recovery? Have you got a budget? Have you got a counsel's opinion? Have you done all of this work beforehand? Because if not, we're going to look at it and say, you need to go and get all these things, or at least attempt to do some of this work, because otherwise we can't get involved at that stage.
I think that's very sensible. Certainly, people I've advised and looking at our modelling, we see occasionally the need for doing it prior to letter for action, but it's very rare. You want to have your lawyer sufficiently engaged on a CFA to understand the case, and you understand the case, to at least get a letter for action, trigger the sort of pre-action protocol, focus on getting a decent response back, get an idea of what the challenges will be to the claim. That can often be a case to mediate, in which case the creditors benefit and there's nothing there for anybody. If you want to go further in issue, having had exchange, you need to get insurance, then you need counsel, and therefore litigation funders are likely to be discussed at that stage, even if it's seed funding or seed funding plus, because I think you can still issue and then settle quite quickly. Statistically, there's quite a few that settle around that stage, and then you're in for the long haul. So there seems to be what I wouldn't advise an IP to do is to sort of assign a claim for 50% essentially before you even send the letter for action. A letter for action is sent and it settles, and you've given away 50% for effectively the cost of 10 grand worth of reading a file and sending a letter. That would be almost a breach of duty by the IP. So I'm very careful to make sure that the IPs are taking proportionate steps.
Yeah, so to get the homework done, that initial work done. I think of all the insolvency cases we've done, we've only got involved in one post issue. Then they've all been, post letter before action, pre-issue, where the lawyers are engaged. If you haven't been to counsel yet, that's fine. Counsel are inherently expensive, and every case that we've taken on, we have paid for an opinion, where we will go and seek a view, even if you have your own counsel's opinion, we'll normally go and get another, just for our own internal underwriting perspective, and that's our cost. If it comes back and says this is no good and you're rubbish at your job, why did you think this was any good? Then, well, fine, it's just that's on us. But would always encourage, particularly on the recovery piece. Are we all going to get paid at the end of it if we do win or we do settle? It's amazing. A lot of people miss that part. You can have a great claim and an amazing piece of paper that says you've won, but it does not mean you're going to get paid. So we would typically always say we haven't got to have a detailed asset schedule about this is exactly what we're going to do, but a good understanding of we believe this defendant, whether it's an individual or a bank or a corporate, is good for the money because because of X, Y, and Z. Then great. But without that, that's the first thing we'll send you back for is please go and tell us how we're going to get paid at the end of this.
Do you get involved in that at all? Do you rely on the client and the lawyer to tell you and update you on the recoverability, the assets of the target?
I mean, we'll do our own underwriting against the defendants, and we have relevant systems and data providers that can give us that in terms of the financial viability of companies. Again, it goes back to the point we were talking about earlier. In a well-presented case from the law firm or the office holder, it should have a section in there on recoverability. If that's missing, we probably wouldn't even go into reading the rest of the memo. Go back, tell us how this is going to work. We will sense check it. We'll do our own homework, but we need you to have a plan on what you're going to do and how you're going to recover. We can't go and recover it. We're the funder. We're not the lawyers. We can't go and enforce this. It's something that you guys have to do. So you need to tell us what the plan is.
Okay, another point I'd make from, I suppose, semi-bitter experience. I've had a few cases where the litigation funder has dropped the case. On one I inherited from the official receiver, a couple of others lost or whatever. It's the same for IPs in a CFA, although often many they don't realise, is in all these CFA and contract agreements there is the term which effectively says that if you go off the claim you can withdraw, you can pull out. Now, that's fine and perfectly logical, but if it's not understood by the other contracting party, the IP, they may not be aware of what danger there is for them in that. So in the case I inherited from the OR, got appointed effectively after litigation had started, immediate disclosure by the defendant, which proved that the case was rubbish. Counsel said, end it. Funder said, okay, I'm finished. Lawyers came off the record. And so I was left as the successor claimant and an ATE policy that I hoped would pay out. And nobody came to the consequentials. Actually, I'm representing the consequentials. And if that had been a CFA, it's broadly the same thing. You've got a stronger relationship with the solicitor who you hope turns up. But if you actually read their contract, if they say, well, I think this case is dead, going nowhere, they can walk away. So one of the things I've raised with people in litigation funding is most of the contracts sort of contain an exclusion from covering things like consequentials, or it's an optional thing. In terms of selling the case, it would seem to me that the well-informed client would be insisting on looking for a stronger exit clauses. Essentially, if we decide it's over, can you just not just walk away? Can you deal with the mopping up of the mess as part of your budgeting? Because ultimately it's a budget times risk sort of thing. So when you go into it with your seed funding, also have an exit expense that you expect to incur in getting out, because you want the client to survive to come along and buy another one of your products. So I think that's where the client would be most vulnerable and would most appreciate clauses that would help them out, be them both the lawyers and the litigation funders.
Yeah, no, it's a really fair point. I mean, I would like to think majority of LFAs will all have, a material adverse decline clause, which says case goes south, you have the right to withdraw, and quite often that'll be agreed amongst all parties. If it's not, there's normally a KC clause that says, if a KC says yes, this is now rubbish, and that's their decision, then everybody is bound by that decision, and the case falls away. It's very much at that point the relationship you have with your client is tested, because you're right. You want to work with this person again. It's not their fault. It's not your fault. It's not the lawyer's fault. Anybody's fault. Maybe that the case has faded away. It could happen for any number of reasons. It could be that the defendant has gone bankrupt, at which point it's no longer efficient to pursue. But it is, there's a lot of tidying up that has to be done in these examples. The funder's going to sit there and say, well, I've lost money because you've been paid, Mr. Law, and Mr. Officeholder, you may have been paid as well. I'm the one that's out of pocket. I bought insurance, I paid all these fees. So we want a nice tidy exit where we can avoid as much damage as possible, further damage. But again, you don't want to leave everybody out to dry and just say, well, you guys deal with it now because as per clause X, we can leave. Otherwise, you're not going to get much work from them in the future. And you only really know how good your relationship is with your client when it goes wrong. And it will go wrong. It's litigation. It always goes wrong. You can normally save it and salvage it, but things happen. It's litigation. It goes up, it goes down, and it does put a real stress on your relationship. So at that point as the funder, you evaluate, right, what is my total exposure? What is it going to cost me to get out of this tidily? And I want to ensure that this liquidator instructs us again.
Yeah, but that's still relationships. You could, litigation funding guys move between litigation funders. Suddenly my mate's no longer there and it's some cold accountant who's sitting there going, nope, we don't have to pay another penny. Thank you very much. You're on your own. That's the concern, I think, for IPs at the larger claims. There's a need for contracting that. But I think on any level, I think some IPs have some comprehension of being liable for costs in some circumstance, for example, or just criticism. But it's a completely different thing to be naked before the court, really, with no representation whatsoever and no funding. We're big and tough, and we've got in-house lawyers and things like that, so we can cope. But it's an observation that it's missing in CFAs, it's missing litigation funding. So through the podcast, anyone listen to this, I think you'd be thought of as a good litigation funder if you led with saying these are the little bells and whistles that we add to make sure that you're never in a position we may drop it, but we'll still have in our budgeting a small amount to cover the exit routes, the tidying up, the legals and consequentials, effectively to bring it to a conclusion satisfactory. That would be a very good, proportionally quite a cheap part of the model, but it would be a good sell.
Yeah, and touched upon at the beginning of the podcast, that these cases, they are assets and they have to be looked after, and the asset management of these cases is so important, and that you forecast, as far in advance as possible. If something's going wrong, you get on it pretty quickly to try and fix it and salvage it, and also that the quality of your funding agreement, the quality of your insurance wording is as tight as it can be, so that in the event of adverse decline, that you have everything in place to protect everybody.
Well, this is a podcast for IP, so you've got to remember the risk and return profile is asymmetric. All I'm in it for is my duty, which only goes so far to creditors, and my fees. And if the small fee that I can get is outweighed by the massive unlimited potential liability for costs if things go wrong and I'm not insured, and criticism, most IPs would correctly say, no, thank you, I'll sell it. And they sell it too cheaply. The way for IPs to be able to fulfill their duties and litigate properly, investigate more, is to make it safe for them and to give more products out there which are thinking about, firstly, how much is the return to creditors, but also what are the risks on an IP, both reputationally and financially, in engaging in this stuff. Particularly IPs, of course, got claims in their own name, wrongful trading, things like that. So your litigation funding, you don't want to be personally the claimant with no funder. Another thing is funders going bust on you and things like that. You want to know that your funder is there for the long term. You want to understand the return, but also if I do this and that and the other and I get no fee, why would I do all this work? And also, and then at the end, I may also be personally liable for costs. You're just killing half the market as a profession, essentially. So leading with ways to comfort and protect the IPs, I think would get a lot more work into the market and a lot higher quality work into the market.
Yeah, an IP is not going to want to go in their own personal name if they think, oh, hang on, this could go belly up quite badly and quite quickly. So they do need to have the relevant protections in place. And I think that's why it's really important that, if you are going to pursue a case and rather than sell it, you are going to bring it, you choose your funder very carefully. You choose your insurers very carefully. And you ensure that, you get proper advice on the quality of your agreement, funding agreement and insurance. Right, it might cost you a few thousand here or there, whatever it may be, but I'd rather spend 10,000 and get my agreements watertight than be on the hook for potentially hundreds of thousands, with personal liability.
It's a real gateway. I think in terms of the art of selling. Often it's the lawyer selling the case to the litigation funder for their fees, and everyone's forgetting the poor IP whose name the claim might be in, or the creditors who were there. So it's very much in terms of, I think that's an area for the market to really explore and lead with. I think there's too many discussions about the internals and the deployment of cash, and not enough about how can we make the clients really, really happy and the creditors really happy. Share some of the insurance, assign it to us, and you get 10% back either way. That type of thing. That would be good. Anything that would really sort of change the dynamics of the market, I think would expand it. Particularly with things like AI coming in, where AI is being used to find claims now, and that's only going to increase. I'm working on the assumption that every claim that ever could be brought will be brought, because AI will find it, and somebody will come to you and say, you may not know about it, but here's a claim that my AI has identified. All these competition claims and group actions and things like that are going to be coming from every angle. So there's more cases going to come into the market. You want to remove the barriers.
Yeah, exactly. And there's quite a lot of talk actually on AI and litigation funding that I'm seeing bashing around on LinkedIn. I mean, my view is maybe AI is not going to replace my job, and it's not going to replace the job of a really good case manager or an asset manager. In the high volume, consumer claims, your financial mis-selling or PCP, whatever it may be, maybe AI can have a role in that. But when it comes to negotiating agreements or managing settlements and day-to-day management of these cases, I don't think there's going to be too much AI involved, which I find myself, going to respond to these posts on LinkedIn. I think no, just you've written it out now, so just delete it, just delete it.
I was going to say, if AI does replace you, then obviously you've got your music career to fall back on, playing the hits of bankruptcy.
I'd like to see AI drink pints on a pavement at 5 p.m. It's not going to be able to do that.
Oh, now we're getting to the heart of litigation funding. I think that's it. We've hit covered quite a lot there. I could talk for hours about it, but other people are probably driving and could crash the car. So, anything else just to wrap up? Any other points you wish to make that I haven't covered? Got anything on your list?
No, not really. I think the market as a whole for litigation funding in insolvency at the moment is a little slower than it has been, and I'm not sure if that's just due to lack of good claims, lack of appetite, lack of capital. I'm not quite sure. I mean, we're seeing some good claims come through, but versus last year, and certainly the year before, the volume of claims has slowed down. I mean, maybe it's because we're at the higher end of the market, and there's just not as many of those about. I'm not sure, but I think everyone. You speak to any funder, they say we want insolvency. We want insolvency claims. Funding was born out of insolvency, so it'd be interesting to see. I think how the market develops. Kind of post summer break. See what these claims are like, and the size and the volume that's going to come through. But I don't know if it's just a temporary lull or there's some jitters. We'll just have to wait and see.
We'll end it there, I think. I think that's covered pretty much, gallop 3 and 45 minutes, everything you need to know about litigation funding. Thank you very much for being my guest, Charles. Good to see you again. And if you liked what you heard, please like and subscribe in the usual way. But that's been Dodging Bullets. Thank you very much.